Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. With me, my good friend and special guest, Dr. Friday with Dr. Friday's tax and financial firm over in Brentwood, Tennessee. And you know, one of the things there, that enrolled agent part.
Yes, that's what I am. You're absolutely right.
Which allows you to
represent and do taxation. Basically, I'm an enrolled agent licensed with the Internal Revenue Service to do representation and taxation. So that's all I do is taxes. I either can keep the IRS away from you. I'm like a shield. I'm like Superwoman. No. Or mainly, if you get the love letters, I can help you resolve that. Vice versa, if you just need help doing taxes, that's what I do.
Okay, so you know, yes, if you do get into trouble, if you do have problems like that, you don't want to be, you know, that's what is that saying about someone that represents himself? I think it's a legal thing, right? You represent, if you're your own lawyer, you have a fool for a client. Yeah, we don't want that. So the same thing goes. You know, you want someone representing you that knows what to say to the IRS, that keep the emotional part out for you and make it a lot less stressful, and knows how to, you know, what the rules are, what needs to be done. It's a very big business thing. Let them take care of it, and that's what she can do for you, which, you know, that's one of the areas if you're having problems, one of the things, don't be an officer, don't stick your head in the sand, go get, you know, some help with that and get those things resolved, because the longer you wait, the worse the problem typically gets. All right, we're talking about required minimum distributions, and one of the other parts that comes with that, when we're planning for RMDs, we know that that's coming up. I look ahead, I'll do projections. That's the whole thing, like when we're doing the planning. And again, for the first 10 callers to my office, I just drop that in there real quick. For the first 10 callers to my office, 615-376-5325. All right, we'll do this planning for you. You can come in. Tess is standing by. She'll send you out a little packet, a checklist of things to bring, like tax returns, investment statements, and those kind of things, so we can do this planning for you. And basically, I'll take it, same thing. I'll look at your taxes and I'll look for ways that I can help you minimize taxes. We'll look ahead and see, well, at 70.5, what are your required minimum distributions going to be? What's that going to do to you in terms of tax bracket? Maybe doing some Roth conversions in the earlier years will help you avoid those kind of problems down the road. All of that, this is why we take that longer view in terms of what we're doing with regard to taxes, about not just taxes this year. Sometimes paying a little more now can save you a whole bunch later, and that's part of the analysis that we do. And I work with Friday quite closely. She'll come in a lot of times, and we've got a client right now, for instance, that's got some charitable deductions that's you know, that she's going to be able to take advantage of, and we can do some Roth conversions, get some offsets, and there's a way that we can save her some money down the road as far as taxes. So if you got a charitable deduction, you know, there and show you ways to get a charitable deduction. There's another way for both a combination of estate planning, income planning and retirement, and tax planning can come together and give you some true, you know, some real benefits and advantages. Knowing how these strategies work and how to set them up is key. All right, we got another call. What was the name? Taylor. Taylor, welcome to the Retirement Report.
Thanks.
Yes, sir. How can we help today?
Experts for this program. I've got a quick question. I just turned 74, but I was 73 at the end of last year with 5 or 6 different IRA accounts totaling $180,000. Can you tell me a rough percentage it would be for the minimum distribution on that?
Rough percentage. It's a divisor, by the way, and if at age 70, well, for this year, you're 74 this year, right?
Yes. Okay,
so 74 is 23.8, which is a little more than 4%. So on 180,000, you're talking about about $7,500, give or take, somewhere between 7,500 and $8,000 in required minimum distributions.
Okay. Well, what was the percentage you said again?
Well, again, don't use percentage. It's a divisor. And what you want to do, here's how this works. The rule basically is that, and your custodian should be able to help you, but if you're going to, because you got 5 or 6 different accounts, you have some different choices you can make too. So one of them, you could have that RMD, the required minimum distribution, come out of each of the accounts, or you can, you know, take from one or the other, as long as there's enough in it to meet the requirement for all of them, or for, you know, like I could take from 2 to meet the requirement for 6.
Yeah, I usually just take it out of 1.
Okay, so if we're going to take it from 1, here's what you want to think. And then, so if you want to calculate, you want to look at what the value of all the accounts were on December 31st of 2017.
Right.
Okay.
189.
You take that value. So if it's 180,000, you divide that amount by 23.8. So you divide it by 23.8, and that would be your required minimum distribution.
Very good. Thank you so much. And again, thanks for the program.
Sure thing. Take care. Thanks. Now, this one, when it comes to requirement minimum calculating again, the calculation part, looking at other opportunities. Now, most people are doing just that. They say, well, I just want to take out the amount that I need to take out. I don't want to take out more than that.
Right.
And that's great if you're in that position. But here's something to keep in mind.
Taxes.
12% bracket again. All right.
Who's gonna go there?
If you're in a 12% bracket, and let's say I take my required minimum distribution, and I still got $20,000 or $30,000 before I cap out and bumped up to the next bracket. Well, why don't I do a Roth conversion on that and only pay 12% tax? Now I can take 12 or 30, and in particular, I take my required. By the way, if you're 70.5, you have to take the required minimum distribution first. Then we can do the conversion. So if we do $20,000, let's say, in converting over to a Roth IRA, and we're only going to be 12% tax on that. So for $2,400, I now have just created a tax-free account, which guess what? I don't have to take required minimum distributions from Roth. So there's another thing. I can delay, I can put that over now into a different kitty, and that reduces my RMDs for the future, which comes to where we get into planning.
Yes,
if I look ahead when you come in to see me and I'm looking at your plan, I'm saying, oh, if you hit, RMDs at what you're doing right now, and based on the projections of how much your accounts will grow and what the value will be and what your RMD will be, and it's going to push you up into a 22 or 24% bracket, why don't we start doing conversions now?
Exactly.
Okay, to reduce down the amount that's in the traditional, so that we reduce down the RMD and maybe keep you down in that 12%. We do all these calculations for you as a part of it. So again, if you're one of the first 10 callers to my office today at 615-376-5325, Tess is standing by. She'll get your information. This is stuff we can do for you, okay? We can show you how this works, and again, at no charge. So again, first 10 callers, 615-376-5325, and when you come in to see me, I'll give you a free copy of my book, 7 Steps to Financial Freedom in Retirement. IRA Mastery, we get into Roth conversions on chapter 3 of that book, by the way. All right, when it comes to Roth conversions, this is one of those areas that I think it just...
People don't maximize. Now, did they make any changes on that in 2018?
The biggest change, and it's great, one of the biggest changes that's happened with regard to Roth is this. In prior years, we could do a Roth conversion, and then at the end of the year, someone kind of mess up and say, oops, I didn't mean to take that amount. It's actually pushing me into a higher bracket. I miscalculated. I made a bunch more. I got a bonus maybe at the end of the year, and it bumped up my income. Whatever it is, we were able to do what are called recharacterizations. We could get a do-over. We could say, oh, we didn't want to do that. We're going to turn that back into a traditional IRA and not pay that tax. We're going to keep it in tax deferral, in other words, and not do the conversion. And then we can do the conversion later. Or we can do a partial. We can do any number of things there. We have that flexibility. However, now, 2018 and beyond, no more recharacterization. So whenever we have to be very careful, maybe give a little more cushion if there's some question as to what your income is going to be, to make sure that it's going to do what you want and you're not going to pay more tax than you need to. And that again, we can't go back and do a do-over after this.
So you're going to want to get a second opinion when you're thinking about, or at least making sure you've got the documentation and the calculation, because I can remember more than one time walking into your office where someone had maybe had a CPA or someone else doing their things and finding out that, wait a second, this doesn't, now I'm going to owe $20,000 because this wasn't calculated right, and you're like, oh, no worries, we'll get that fixed. Now you can't fix those mistakes, and that's going to be very, very costly to some of these people.
And this goes to the do-it-yourself, person again. Here again, what we want to do, we're calculating out what the tax impact is going to be prior to making the decision to do something. So, and looking at things like, well, making sure this is going to keep you in, let's say this year, that'll be the 12% bracket, and prior years at 15% bracket. The other thing is making sure that we're not going to be triggering any, AMT tax. This is one of those, talk a little bit about the alternative minimum tax. This is like this hidden shadow devil government thing.
Right. Well, the alternative tax is another tax code that runs within our tax code, and it's supposed to be designed designed to basically keep the tables more level. So if a person that is, and this is where I have a definition, but wealthier individual that maybe does a lot of things through stock, through conversions, through non-earned income, selling of things, that they still pay their fair share. So instead of paying ordinary income tax, AMT tax, which now I do believe it is actually set up to actually change every year, have a cost of living built into it, had not in 30 years it stayed at. So basically it was set at like 30, 40,000 20 years ago, which was high income, became more lower middle income. I mean, theoretically it started kicking in at 45. Anyways, it's 24% it starts out at. So that's a huge difference than 10, 12, 18 or whatever, 22 I guess we're going to now. So that one is going to be a huge one, but we have had it more than once kick in because somebody has either sold a piece of real estate, done a conversion, and the one we were talking about here where she may have a lot of extra money in charitable contributions. The government basically says, wait a second, because you can afford to do that, that may not be fair across the board. So we're going to add this AMT tax to make sure we get a little more from you because you can afford it. That's the theory.
Death and taxes, right? Well, we can't avoid them, but we can hopefully we can extend out the date for death, and we can reduce down the amount we pay in taxes. Those things we hopefully can do. All right, we're going to take another break. When we come back, we're going to dive into this a little bit more about taxes. And if you've got some questions, give us a call. But one of the things I want to talk about with this Roth conversion, how it works, how you can benefit from it, and also talking about some of the changes now for 2018. For 2017, make sure you get them in, and for 2018, we're going to talk a little bit about now some tax planning to minimize your taxes for this year. All right? Keep it in your pocket. Don't give it away. All right. We'll be right back. Join us here on the Retirement Report.